Hey, greetings and welcome to the first investment strategy brief of 2023. And as is our practice in this first episode, if you will, this first recording, we're going to jump into our outlook of 2023, what we called finding balance. I really want to cover in this session three topics or three segments. First, we'll look back at 2022 and sort of relate it to and then share with you our outlook for 2023. I do then want to share a little bit about other articles that are in our report. We'll share a few details about that. And then finally end on allocation insights and investment guidance. So, when we look at the report for 2023, again, we call it Outlook 2023 Finding Balance. And the spirit with this is the idea, and we're going to get into it a little bit, that we've come through a pretty tough time, especially as it relates to inflation and Fed policy, driven by some imbalances that we've talked about and we'll talk about today. And that the idea then is, as we look forward and make our way through 2023, that we're going to look for ways of finding balance for things to kind of calm down and settle out. And so, the bottom line is this report overall has a number of articles, but the anchor to it, of course, is our outlook for 2023. But to set the stage, let's take a look back at 2022. We've talked a lot about the kinds of things that have been causing trouble: challenges in DC, persistent inflation, a more hawkish Fed, the risk of recession, a slowdown in earnings, weak markets as a result, and then geopolitical tensions kind of just all the way around. And so in our Outlook report, the full report, we include an article that we, basically say, hey, we're going to do 2022, that year in review. So let's dig into that a little bit. We know, as we've talked about for a number of months, that the whole idea is that we've had elevated inflation, and that's so right now. And I think this is a formal print. The consumer price index for the full year was 6.5%. Well above the Fed's 2% target. And what that has meant through the year in 2022 is that the Fed has had to act, turn more and more hawkish. They hiked rates, their Fed funds rate, a total of 4.25% over the full year. That was in 7 different actions through the year. And that's meant that GDP growth has been less than expected. So right now, the estimate for 2022 is 1.9%. And markets have reacted negatively to all that. So markets, were down 18%, 18.1%, defined by in this case, the S&P 500. Now, we also know, for example, with the higher Fed funds rate, that we've had higher market rates, which have driven bond prices lower. And that means that the bond market is down as well in double digits. If you look, for example, at the aggregate bond index, which measures investment grade bonds in the U.S. So it was a tough year. And, as I mentioned, a lot of it relates to inflation. So let's dive into inflation a little bit. We've looked at this chart before. This has been updated all the way through December. And this happens to be monthly changes. And we've sort of scaled it to see the energy has been quite volatile and for a period was really quite elevated. Food has been elevated, but in a stable way, which is unfortunate. And then goods and services, you can see goods has actually turned negative, and services has stayed kind of sticky and positive, related to a lot, basically to rents, to housing. And the other thing that we've added this time is if you will, the weights in the two respective indices. So then in each case, the percent on the left represents how much that component represents in the CPI index, and the one on the right, which is a little bit higher number for the top two, represents the weight in the core CPI. And so what we can see here is that goods and services really are the kind of the bulk of the index. Energy has been volatile. It's right now about 8% of the index, and then food, which has been sticky and high, 14%. Now, as we've done in the past, when we roll this up to a year over year and look at how those components stack up, sort of normalized for those weights, and look at how it's gone, we can see that inflation is starting to cool. And this again is looking back 12 months at each respective month. And the good news is, for a good amount of time now, that number has continued to decline. It's the kind of thing that the Fed is looking for. But in some ways, I like to think of it as looking at monthly data might be a little too short, annual data maybe a little too long. So I sort of split the difference and said, let's take a look at 3-month rolling. And so here, first, I just look at these month over month and just think of it as in each bar, it's basically the 3-month average looking back. So we've got this rolling inflation. And a couple of things kind of pop out on this. The first is that we see goods have actually kind of, as they made their way, and by that measure, has actually turned negative, meaning prices are declining. For services, they're a little elevated, but you can see very slightly that they're starting to fall. Same thing with food. Essentially a nice sort of subtle decline in this 3-month rolling average. And then what's kind of interesting with this is we've had obviously this big sort of move related a little bit to the Ukraine war, for example, of energy prices going way up. And then when we look at these sort of 3-month rolling averages, you can see that basically we've seen energy prices decline. And we all, of course, has experienced that, for example, at the pump. So I'd say that just intuitively, this looks like pretty good data, right? A sort of a trend in the right direction. And in fact, if we roll it up, now this again is monthly, but I'm going to roll it up to the CPI and look at the 3-month rolling average for the full headline index. And what you can see is that essentially we obviously had elevated inflation, but boy, over the last, call it 4 months for that 3-month rolling average, the numbers have really come down. And notably in December, again, looking at the 3 months ended December, basically it's a print that is just at or maybe slightly below that green line. What does that green line represent? Well, it's basically a monthly number of 0.17. And why that's important is if we compound that up for a full year, it's the Fed 2% target. So you can see here that basically for this 3-month rolling average, we decidedly got below and slightly below the Fed's target for the 3 months ended December. And that's pretty good news. So we'll see. We've got a Fed meeting coming up. We'll see how the Fed reacts to that. But I would say as it relates to kind of what's going on with inflation, things have gotten, a little bit better. All right, so let's turn and look forward. Our outlook for 2023. And as we always do, we basically like to talk about it from the perspective of a more sort of a relatable sort of discussion, like what's going on and how do we see things unfolding, and then we'll get to some of the numbers. We like to think of it as the year of 2023 really happening in 2 phases. The first phase we're in the middle of, which is, hey, there's uncertainty with inflation. It started to cool, but the Fed hasn't yet signaled anything other than a super hawkish policy. And the bottom line is what we think is that things will remain a little bit uncertain. And it will mean that we'll have increased volatility, the prospect for weaker markets. But then as we make our way through the year, and our anticipation is we'll see inflation continue to cool, the Fed essentially to pause and sort of back off, if you will, of a hawkish shift, that should lend to sort of a sense of finding balance, a sense of feeling better about things. And that should lead to a second phase this year, which is relief, and the idea that sort of we come back to the fundamentals, maybe things, economically don't get too bad, or earnings don't decline too much, or earnings growth doesn't decline too much, and we kind of find ourselves in a place of finding balance. And so, long story short, we sort of see these 2 phases, volatility and things calming down a little bit. And when we add it all up, here are some of the numbers. So we see for the economy, let's start there, that we're not really sure where we're going to have a mild recession. We don't think we'll have a deep recession, but we could have slightly negative economic growth, slightly positive economic growth. But, right now our sort of forecast for the full year is somewhere between negative 0.5% and positive 0.5%. That's just a signal to say a real slowing in the economy, but not a severe recession. We do think inflation will cool down. The metric that we tend to forecast is the core PCE inflation. This is one that's favored by the Fed. We see it coming in at 3.5% to 3.75% by the end of the year for the full year. And then Fed funds rate, what we think from here is that the Fed will hike altogether in 2023 another 0.5%. Could be a 1/4 point at the first meeting, another 1/4 point later down the road. But think of it as another 0.5%, which is pretty darn sort of tight in terms of Fed policy, and that they'll sort of pause and wait for the lagged effect of all that they did last year, that 4.25%, and essentially watch the data, watch inflation, et cetera. Now, what does this mean for markets? Well, first I'll mention Market Pulse publications. Recall that we publish this Market Pulse document any day that the S&P 500 moves down or up 2%. It's just sort of a trigger. When that happens, we're going to publish. And last year we did about 50 of those, believe it or not, just quite a volatile year. And so we expect about half of that here in 2023. As it relates to sort of the cumulative return for the market, we forecast the S&P 500 as a popular index. And think of it as two numbers that sort of relate to each other. We think the total return will be about 6%. It's a little bit less than our long-term forecasted average. And that happens to translate to a real round number for the index of 4,000, getting back to 4,000. Now, we've seen Treasury rates move around already this year. We think that towards the end of the year, it will be range-bound between 3.25% and 3.75%. And then spreads, both investment grade and high yield, think of it as about where they are today. We've published a couple ranges, 100 to 150 basis points, or 1 to 1.5%, or 450 to 500 for high yield, 4.5 to 5. And again, I think the main takeaway is we don't see spreads widening out significantly, which can happen in a stressed environment. All that translates to then probably a pretty good year for fixed income as well. Okay, now when we do this work, I always like to say we make these forecasts, point forecasts for sure. We know the probability of hitting 4,000 exactly is very, very low. We're sort of setting a direction, modestly positive. And so that's, I'd say, captures our base case, the idea that inflation cools, the Fed calms down a little bit, markets ultimately respond to that, and we end up with a modestly positive year for 2023. In any event, we like to model other scenarios, challenge ourselves to say, well, what if we're wrong in the negative direction, what we call the bear case? And then we also model, well, what if we're wrong in a positive direction, meaning the bull case? And so let's walk through the way we thought about that and what could unfold. In each case, we think of the possible scenarios, we've sort of framed them out to be related to inflation, monetary policy, and earnings. And so in the case of the bear case for inflation, the spirit of that would be to say, hey, it stays sticky, doesn't come down despite all this Fed action, and the Fed has to stay increasingly more aggressive. If that happens, we think markets react negatively to that, and that will lead to, essentially, and I should say, a further slowing economy, probably a recession, and maybe a severe recession, lower earnings, and markets are going to respond to the prospect of that, and ultimately we'll see negative returns from here. On the bull case side, essentially it's the mirror image. Imagine that inflation cools very quickly. The Fed can back off very quickly, maybe even ease rates a little bit. Ultimately, if they do that, the economy, we experience a reasonable soft landing, maybe earnings starts to stabilize and continues to grow in a positive direction. And I think importantly, we see sort of signals from companies that things are getting better. That would be the bull case. Now, you can see that the article describes these two cases as having quote-unquote fat tails. That's sort of risk analysis jargon, and the idea being that we think there are higher probabilities of those two scenarios. So we've ascribed, these are all estimates, a 60% chance that our base case will unfold, actually a 25% chance that the bear case will unfold, and then to add up to 100, what's left is 15%. And that's what would cause the probability of the bull case unfolding. So that's, those probabilities for the tails, the bull and the bear, are a little bit higher than normal. So we call that having fat tails. In any event, what does all this mean as it relates to markets? I think one of the things we have to want to remind ourselves, is that the market is sort of a forward-looking thing, in the sense that what happens ultimately is the market will peak, and this is just an average sort of pattern going back many, many years. The market tends to peak in advance of the economy, and it tends to recover, kind of start growing before the economy bottoms out and moves higher. So think of it as, when I talk about the sense of finding balance through the year, we may end up, with a soft sort of negative environment for the economy, for example, but that won't keep the market from recovering if it does sense that, this idea of finding balance and some kind of confidence that earnings will continue to grow and maybe grow at a faster rate. So we just want to remind ourselves, you want to be careful, because the market's going to anticipate that positive environment down the road. Now, people have been asking, okay, are we going to have a recession? We right now think it's probably second half of the year. If we do have it, it will be mild. Here is our recession dashboard. Those that have been looking at this month to month have seen things go from green to yellow to red. We did flip a yellow to red ISM new orders, just another sort of metric showing contraction, if you will. And so this is a very sort of cautionary sort of set of data. We've got a bunch of red, some yellow, and just a couple greens on the page, if you will. So again, we have to be mindful that we could see negative economic growth kind of at any time. Now, as it relates to finding balance, I think it's helpful to understand that we do sort of set ourselves up to monitor for that. And in the report, essentially, we laid out 8 different signposts that we're going to be looking for to kind of see where things might unfold. The first, and I'll just run through them quickly. The first is China. China's trying to reopen. They're on a path to economic reopening. We can almost check this box. It's going to be a little bit rough, right, with their COVID challenges, but they're trying to basically reopen and move away from zero COVID strategy. Next up would be alignment of market expectations with Fed forecasts. I think the two are out of alignment right now. The Fed is sort of calling for higher rates looking forward. The market thinks they'll back off from that, and that's out of alignment. So we'll look to see that become more in alignment. A trough in consumer confidence. Consumer confidence is pretty negative, but it stayed down there, right? And so think of it as wanting to see a little bit of stabilization and recovery. I mentioned a moment ago sort of shelter, housing. Shelter costs have been going up, and that's a really anchor component to inflation. So if we see shelter costs stabilizing, and therefore reflected in the inflation indexes, that's a positive. Now, wage growth has been a little bit higher than normal and sort of at a level that the Fed's a bit uncomfortable with because there's a view that higher wages means higher inflation. So the Fed's looking, it's almost like they're doing what they do to slow the economy down, loosen the labor market a little bit, and maybe we'll see wage growth slow. Similarly, then, the idea of the labor market being in equilibrium. So right now, there are many more jobs at least listed as open than there are workers to fill them. So we'd look for those two sort of kinds of data to get more in alignment. I mentioned before the idea of company earnings. If we see some evidence that they're starting to calm down about what they've been through, and as they provide, for example, forward guidance, if that starts to improve, we'd view that positively. And then a final thing I'll mention, which would just be good, is we've got a few hot spots geopolitically around the world. Obviously the war in Ukraine, we've got some tensions with China. Any kind of diplomatic progress on all that would be a positive. Now, as we did last year, we have framed out, when I talk about the idea of volatility and kind of watching from the first half of the year roughly, we do have a bunch of dates where we know we're going to get data on inflation, on the Fed, on the consumer, on housing. And so we kind of updated this calendar just to kind of capture some of the key dates we know we're going to have to focus on to see where things are headed in terms of day-to-day volatility and things feeling like they're improving or not. So that just keep in mind these dates as we look forward, and we'll be reporting on them obviously through the year. So that's it on our sort of look back at 22 and our outlook. I want to turn briefly to other articles and things that are in our outlook, the broader outlook report. So the first would be an article that's very well done by a colleague, Brian Gardner, Stifel's chief Washington policy strategist. He basically covers sort of 3 anchor topics in this article. The first is division in the GOP. So the GOP now has control of the House, modestly so, and there's division there, right? So there's a lot of negotiation, if you will, going on within the party, and that's going to be, there's work to do, if you will. The second is congressional priorities. What this means is, hey, when it comes to actual legislation, with a divided government, a Senate with Democrats, House with Republicans, and then the administration obviously Democratic right now, not a lot's going to get done unless it's bipartisan. And one of the areas where Brian thinks there'll be a lot of focus, of course, are the basic bills that have to happen, budgetary in nature, et cetera, debt ceiling, things like that. It's going to be a lot of negotiating, a lot of fighting and infighting, but at the end of the day, that stuff has to get done. He does discuss the idea of a regulatory agenda, this meaning for different areas of the government where they can essentially modify rules and regulations to advance the administration's goals. And then finally, believe it or not, 2024 elections. So just sort of setting up for recognition that we're now just not that far away. So again, I would encourage you to check out Brian's article, Washington Policy and Political Outlook. We did also update in the Outlook report our geopolitical dashboard. And, essentially what I would say is there are sort of two things that that we got into. One was sort of countries feeling like they want to take care of their citizens, et cetera, maybe be a little bit less global in nature and be more focused on sort of onshore. And then the second is the idea of a divided world. The idea with this is to say, hey, when we look back at longer history, we've really been in a unipolar world, meaning that the U.S. is really the primary power, and it's a lot about how the U.S. is engaging with other countries and who are our allies and all of that. We're moving to a multipolar world, in particular, perhaps, where China is really emerging as a significant economic player, and we could end up possibly with two blocks, meaning the U.S., our allies and trading partners and all that, and then China with its sort of complement of allies and trading partners, et cetera. So that's, again, we get into this in the article a little bit. In any event, we have a number of different risks that we highlight, things like U.S.-China competition, the prospect of a new Cold War, as I mentioned, in some ways, European fragmentation. And then an interesting one to me is, okay, are there things happening geopolitically and globally that could lead to structurally higher inflation, which is something we'd have to sort of wrestle with. In any event, other articles in the broader report, we have a nice one called 5 Tips to Navigating a Bear Market, our investment management process, just a brief overview of that, our approach to asset allocation, which I'll get to in a second. And then finally, where to find Stifel guidance, and happy to report, as I've done in the last month or two, StifelInsights.com has been updated, and all this content is available. So quick and easy URL to remember, StifelInsights.com. Anyway, let's get to just a little bit of an investment framing. So the third topic is our dynamic leanings. And, I'd say when we wrote this article, I'll get into this, we sort of highlighted three things: the idea of embracing quality, celebrating yield, and actually trusting 60-40. And so when we look at our asset allocation framework, the idea with this is to say, look, most investors will do some work and decide how they want to allocate among asset classes and do so strategically. And the classic one is 60-40, 60% stocks, 40% bonds, but people do all kinds of things. And you can see, in fact, our framework, we end up providing 144 different things to consider, but then a client and a financial advisor can even customize against that. But the spirit of it is to say, look, you want to be diversified across and within asset classes, and it's very reasonable to set some kind of strategy, have it be strategic, meaning long-term in nature, and sort of go from there, and you have ways of implementing in the asset classes. It might involve passive management, might involve active management, but we're very supportive and think it's very important to invest strategically. But with that said, we have a number of clients that do want to allocate and advisors that do want to allocate more dynamically, meaning a little bit shorter term in the orientation. And so what I would say is those three themes I mentioned, they kind of come into play in our allocation thinking. So the first is, as it relates to equities generally, we have a view that it is a good environment to embrace quality. So quality in the equity space can include investing in companies that are financially strong. It can include companies, therefore, that are paying dividends, maybe growing dividends. So just having an awareness of that can be helpful in this first part of the year, especially if things continue to be volatile. In any event, though, with the volatility and then the prospect of recovery, when we have dislocation, that actually can create an investment opportunity. So another leaning in the equity space is for those that implement with active management. We think it's a good time to go a little overweight small cap companies. So if you have a skilled investor that is good at finding those dislocations from that volatility and sort of things being a little bit unsure, this is a good environment for those to be able to invest and find good opportunities and perhaps enhance return a little bit. So a modest overweight to active small cap. In any event, that quality theme carries through to fixed income. So the spirit of this is to say we think this is a good environment to lean into quality, and the way we express it in this framework is for those that are invested in taxable bonds, and especially if they're invested some in high yield or below investment grade. This is a good environment to lean a little bit towards the investment grade side, a little bit higher quality. So anyway, listen, that's what we wanted to cover in this episode, if you will, of Investment Strategy Brief. Thank you so much for watching this month, and we'll catch you in February. Thanks so much.